For the next session, we must analyze tender documents for the viability in a new venture context. Only a very few of the tenders will be suited to your business. It would be a waste of your time and effort to respond to every tender that you come across. Responding to tenders can be time-consuming and expensive. In order to make sure that you do not waste your time and money, you will need to analyze the tender to find out if it is a viable tender opportunity. Based on our country, you must follow South Africa's criteria. This includes Black economic empowerment, acceptance of legal terms and conditions, and technical aspects of the client's requirements. These are considered non-negotiable requirements, so we must keep it in mind when analyzing the validity of a tender to your venture. Following this, we need to break down the costs, revenue, and profit of a tender. When a business issues a tender, there is a good idea of what revenue should be generated through the new goods and services. There is an idea of what profit they would like to achieve. Remember, profit equals revenue minus costs. How will the client pay if you are awarded the contract? Remember that this can impact heavily on your business. This does give us some anxiety, but fear not. The client's payment options could be to pay in full, up front, to deposit deferred payments, or even to lease. Now remember, we must push forward with the tender specifications. Check that all requirements called for in the tender are met in your proposal. Be intelligent about internal factors that impact upon your pricing decisions. The internal factors that impact upon price are production, promotion, distribution, and of course, cost. With regards to the product, we must ensure the level of quality, differentiating product lines with organization, stage of product life cycle, and product design is taken care of. For promotion, you can use the usual marketing techniques like coupons, rebates, discounts, advertising, and sales and negotiation, etc. Class self-improvement is the cornerstone of someone in a new venture. Moving on, we must consider distribution. Remember, we must analyze and confirm the distribution channels involved in changing times. Traditional channels versus direct via internet. The next part is usually the longest, so I will have to slide this up and mention one or two of these listed items. Remember that these are all related to cost. Total cost is equal to fixed costs plus variable costs. Total revenue is equal to price times quantity sold. Break-even point is where total costs is equal to total revenue. Building upon the break-even analysis, we can add a desired profit to the cost side of the equation. I know that this is a lot, everyone, but costing is usually the difficult part. But onto the organizational objectives now. These are income being equal to achieving maximum profits, sales being equal to maintaining or enhancing market share, being competitive, which is to meet, avoid, or undercut competitors and social concern. Pricing is important, so we also need to know the external factors impacting upon pricing decisions, which are competition effect, cost effect, the end benefit effect, and the total expenditure effect. The price or quality effect, the sunk investment effect, and the unique value effect. Narrowing down to the product. Does the product have any unique attributes that differentiate it from competing products? How much do buyers value those unique differentiating attributes? You must know about the substitute awareness effect and the difficult comparison effect. Furthermore, to use this method, you need 4 things. An estimate of the units that you will sell, what each unit costs, the total amount of money invested in making and selling, and the product target rate of return that you want on your money. In another formula, calculating target return price will be unit cost plus target rate of return times total money invested. You must know the estimated sales, customer-orientated pricing, backward pricing, prestige pricing, odd number pricing, and price lines. Class, remember to use only a few prices for each of your product lines. Examples: economy line, value line, and high quality line. Do this using bundle pricing, leader pricing, and expenses and revenues. Remember, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in decreasing in equity, other than those relating to distributions to equity participants. And expenses prepaid refer to expenses paid in the current financial year, of which a portion relates to the current year and the balance to the next financial year or years. To wrap up, assess suppliers and new products in terms of potential contribution to profit and securing the tender. I want you all to read, internalize, and commit this information to memory. Study it all further with your notes, people.